Hi everyone, this is Professor Gallagher. In this video, we're going to be discussing special property transactions in Chapter 12. And the quote that we're given on this initial screen, "A fool and his money are soon parted. It takes creative tax laws for the rest," is a good introduction to what we're going to be covering today. So some of the special property transactions are considered to be a little bit more creative tax laws. This chapter is going to expand upon the property transactions chapter that we've already covered in this course. So we're going to go ahead and start with like-kind exchanges. So there are three rules that must happen for a like-kind exchange. There must, first of all, be an exchange. The property transferred and the property received must be held for productive use in a trade or business or for an investment. The property must be like-kind, and the exchange rules are not elective. Hi everyone, in this video we're going to discuss special property transactions in Chapter 12. This is going to expand upon the coverage of property transactions that we've already talked about in a prior chapter of this course, and we're going to start with like-kind exchange rules. So there are three rules that must occur for a like-kind exchange to happen. First of all, there must be an exchange. Second, the property transferred and the property received must be held for productive use in a trade or business or for investment purposes. And third, the property must be like-kind. The exchange rules are not elective for this, so if there is an exchange, then we do need to treat it as such. In 2018, like-kind exchanges only apply to real estate. So in prior years, this could also apply to business equipment. But from 2018 on, it's only going to apply to real estate transactions. So dealers do not qualify for like-kind exchange treatment. So if you are, for example, a car dealership, you can't exchange cars as inventory and qualify under the like-kind exchange rule treatment. Only real property, land and buildings that are used in a business or held for an investment can receive this treatment. So what is a like-kind asset? It's going to be an asset of the same nature or character, and grade or quality does not matter. If there is any consideration given in the exchange, like extra cash or securities or anything else of value added to the transaction, that's going to be considered boot property. The recognition of the gain is going to be the lesser of either the fair market value of any boot received, so that's any additional consideration that's given in the transaction, or the realized gain on the exchange. The receipt of boot causes recognition of gain. Giving boot does not cause gain recognition. To calculate the basis of the property that's received, we're going to take the basis of the property that was given in the exchange, plus the basis of any boot that was given, plus any gain that was recognized, and then subtract any boot that was received. Or it can also be calculated as the fair market value of property received minus any deferred gain. So under the like-kind exchange rules, an individual entering into an exchange would have 45 days to locate a replacement property for the property that they're exchanging, and 180 days to receive that replacement property. If a liability is released during an exchange, that is going to be considered boot that is received. So that means that the presence of a liability in an exchange can trigger gain recognition. So let's walk through an example of a like-kind exchange. And this example is also going to include boot property. So we have Zach and Vera. They're going to exchange property of the same general business class asset. So their property qualifies. Zach's asset has a basis of $25,000 and a fair market value of $40,000. And Vera's asset that she's giving up has a basis of $20,000 and a fair market value of $30,000. In this exchange, Vera is also giving some securities, so stocks or bonds. to sweeten the transaction a little bit. The basis of those securities for her is $7,000 and the fair market value is $10,000. So now we're going to walk through how gain was going to be calculated on both sides of this exchange. So we're going to start first with Zach. The fair market value of the property that he received was $30,000. And he also received securities from Vera that the fair market value of is $10,000. So the total fair market value of property that Zach received is $40,000. We're going to subtract the basis of the property that he gave in the transaction, which was $25,000, which will give us a realized gain of $15,000. Now, since he received boot of $10,000, the gain that will be recognized on this transaction is $10,000. For Vera, the fair market value of the property she received was $40,000. She did not receive any boot in this deal. She gave it up, so we don't need to add anything there. So the fair market value of property that she received was also $40,000. The basis of the property that was given in the exchange is her $20,000 property plus $7,000 basis of her securities, which gives us $27,000. So the realized gain for Vera is $13,000. Now she did not receive any boot, so she would not have any gain that was recognized. So next, we need to calculate the basis of the property that is received, so the new property. So for Zach, the fair market value of the property he received was $40,000. He also had a $5,000 postponed gain, because if you remember, his realized gain was $15,000, but he only recognized 10 of it because of the boot that he received. So the basis in his property that he received is $35,000. Now Vera, her fair market value of the property that she received was $40,000. She did not receive any boot or anything, so her entire realized gain is going to be postponed. So her postponed gain is $13,000, which gives her a basis in the property that she received, her new property, of $27,000.